Have you ever wondered what it would mean if the institutions that manage the world's money quietly stopped trusting the very asset that built the modern financial system? Not with dramatic headlines, not with emergency speeches, not with stock markets crashing overnight, but through small decisions made behind closed doors, decisions that almost nobody notices until years later. Imagine discovering that one of the biggest financial changes in nearly a century has already happened, yet most people are still living as if nothing has changed. That is exactly what today's discussion is about, because, according to recent global reserve data, central banks have been steadily increasing their gold holdings, while the share of U.S. Treasury securities in global reserves has continued to decline. This isn't about predicting the collapse of America or claiming the dollar will disappear tomorrow. It is about recognizing that history often changes direction long before the average person realizes it. And if Ray Dalio has taught investors anything over the last several decades, it is that the biggest financial opportunities and the biggest risks appear during long-term shifts that most people ignore until they become impossible to avoid. For nearly 80 years, the United States stood at the center of the global financial system. Nations traded in dollars, oil was priced in dollars, international debt was issued in dollars, governments stored enormous portions of their national wealth in U.S. Treasury bonds because they believed those securities represented the safest and most liquid asset on earth. That confidence became the invisible foundation supporting global trade, international banking, and economic growth for generations. Most Americans never had to think about it because it simply existed in the background. It was like electricity, always there, always reliable. But history teaches us that no financial system lasts forever. Every reserve currency eventually reaches a point where new realities begin, replacing old assumptions. Sometimes the transition is sudden. More often, it happens so gradually that people only recognize the turning point years later. To understand why today's shift matters, we have to go back to the end of World War II. The world had been devastated by conflict. Economies were broken, trade had collapsed, and confidence between nations had almost disappeared. Leaders understood that rebuilding prosperity required more than factories and infrastructure. It required a stable monetary system that every country could trust. That led to the creation of a new international financial framework centered around the United States. America possessed the largest economy, enormous industrial capacity, and the world's biggest gold reserves. As a result, the U.S. dollar became the anchor of global commerce. Foreign governments accumulated dollars because they believed those dollars represented stability in an uncertain world. For decades, that system worked remarkably well. International trade expanded at an unprecedented pace. Businesses invested across borders. Families accumulated wealth. Entire industries flourished because the dollar created a common language for global finance. Whenever uncertainty appeared, investors rushed into U.S. Treasury bonds. Those securities became known as the world's ultimate safe haven. Even during financial crises, wars, or recessions, demand for treasuries often increased because confidence in the American financial system remained exceptionally strong. But every long-term cycle contains the seeds of its own transformation. As Ray Dalio frequently explains, history is driven by repeating patterns rather than isolated events. Nations rise. They accumulate wealth and influence. Debt gradually expands. Governments take on larger financial obligations. Economic priorities shift. Eventually, maintaining the existing system becomes more difficult than building it in the first place. These transitions rarely happen because of one dramatic event. Instead, they develop over decades through thousands of individual decisions that slowly reshape the global economy. One of those changes has become increasingly visible over the past several years. Central banks, the institutions responsible for protecting national financial stability, have quietly been buying gold at one of the fastest rates seen in modern history. Unlike individual investors, central banks typically think in decades rather than months. They are not chasing quick profits or reacting to daily market headlines. Their primary responsibility is preserving national purchasing power, financial security, and confidence during periods of uncertainty. When dozens of central banks begin increasing exposure to the same asset at the same time, experienced investors pay attention because those decisions often reflect long-term strategic thinking rather than short-term speculation. So, why would governments purchase more gold when modern financial markets offer countless investment options? The answer begins with one simple principle: diversification. Imagine managing the savings of an entire nation. Would you want all of your financial security dependent upon a single country, a single currency, or a single political system? Probably not. Gold occupies a unique position because it is not issued by any government. It carries no promise from a central bank and no repayment obligation from a borrower. Unlike government debt, gold exists independently of political decisions. For centuries, civilizations have viewed it as a form of wealth that can survive changing governments, changing currencies, and changing economic systems. That does not mean gold replaces the dollar, nor does it mean U.S. Treasury securities suddenly become unsafe. Instead, it suggests that many reserve managers are seeking greater balance as the global economy becomes increasingly complex. Trade relationships are evolving. Geopolitical tensions have intensified. Government debt levels around the world continue reaching record highs. Inflation has reminded policymakers that price stability cannot always be taken for granted. Under these conditions, holding a larger share of reserves in gold may simply represent an additional layer of financial insurance. The remarkable part is not that central banks own gold. They always have. The remarkable part is the pace at which many have been increasing their holdings, while gradually reducing the relative share of U.S. government debt inside their reserve portfolios. This is the trend that has attracted growing attention among economists, investment professionals, and macro investors, including observers of Ray Dalio's long-term debt cycle framework. It does not signal the end of the dollar overnight, but it does raise an important question. Are we witnessing the early stages of another major transition in the international financial system? History reminds us that financial leadership changes slowly, then suddenly becomes obvious in hindsight. Very few people recognize the beginning of previous monetary transitions while they were unfolding. Most only understood their significance years later, after the evidence had accumulated. Today, the world may once again be entering one of those periods where subtle changes carry enormous long-term consequences. And in the next part, we'll explore the forces driving central banks toward gold, why record government debt has become impossible to ignore, and how these developments could shape interest rates, inflation, and the future role of the U.S. dollar over the coming decade. If there is one lesson history teaches over and over again, it is that major financial changes rarely begin with panic. They begin with incentives. Every government, every central bank, and every large institution constantly asks the same question: what is the safest way to protect wealth over the next 10, 20, or even 30 years? The answer to that question changes as the world changes. During one era, government bonds may offer the greatest security. During another, hard assets become more attractive. Today's global economy appears to be entering one of those periods where reserve managers are quietly rethinking old assumptions, not because they expect disaster tomorrow, but because the risks of the future no longer look the same as they did 20 years ago. One of the biggest reasons is debt. Over the past several decades, governments around the world have borrowed at levels never before seen in peacetime. The United States remains the largest economy on Earth, but it also carries an enormous and growing national debt. As that debt increases, more Treasury bonds must be issued to finance government spending. For many years this wasn't viewed as a serious problem because demand for U.S. debt seemed almost unlimited. Foreign governments, pension funds, insurance companies, and global investors consistently purchased treasuries, helping keep borrowing costs relatively low. It became a self-reinforcing system. Confidence attracted buyers, and buyers strengthened confidence. But Ray Dalio has often argued that debt follows long-term cycles. In the early stages, borrowing supports economic growth because money is invested into productive activities. Later, however, debt begins growing faster than income. Governments devote an increasing share of their budgets to interest payments instead of future investment. Eventually, policymakers face difficult choices. They can raise taxes, reduce spending, borrow even more, or allow inflation to gradually reduce the real value of debt. None of these options is painless, which is why long-term debt cycles often create slow but meaningful changes across the financial system. At the same time, the world has become far more geopolitically divided. Major economies are competing more aggressively over technology, trade, energy, and national security. Supply chains that once connected the world seamlessly are being redesigned. Countries increasingly want greater control over critical resources and financial infrastructure. In this environment, reserve managers are naturally asking whether concentrating too much of their national wealth in a single asset remains the best strategy. Diversification has become more than an investment principle. It has become part of national economic security. Gold fits naturally into that strategy because it exists outside the financial promises of any single government. Unlike bonds, gold does not depend on future repayment. Unlike currencies, it cannot be created through monetary policy. It has no earnings, no dividends, and no interest payments. Yet for thousands of years it has maintained one characteristic that few assets can match: scarcity. That scarcity is precisely why central banks continue viewing it as a long-term store of value during periods of uncertainty. This helps explain why central bank gold purchases have remained exceptionally strong in recent years. Instead of making dramatic public announcements, reserve managers have quietly accumulated additional bullion while adjusting the composition of their reserve portfolios. These purchases are often measured over many years rather than weeks. Central bankers understand that moving too quickly could disrupt markets, so changes usually happen gradually. That slow pace makes the trend easy to overlook, even though the cumulative effect can become historically significant. Another important factor is inflation. For many years, inflation remained relatively low across much of the developed world. That created confidence that central banks could always maintain stable prices through monetary policy. But the inflation surge experienced after the pandemic reminded governments, businesses, and households that purchasing power is never guaranteed. Families suddenly found themselves paying more for groceries, housing, transportation, and everyday necessities. Businesses faced rising costs. Investors began questioning whether traditional portfolios offered enough protection against prolonged periods of higher prices. Inflation does not automatically make gold outperform every other asset. There have been periods when stocks significantly outperformed gold despite rising prices. However, inflation often encourages investors to seek assets perceived as preserving purchasing power over long periods. For reserve managers responsible for protecting national wealth rather than maximizing returns, that consideration becomes particularly important. Meanwhile, another challenge continues to grow beneath the surface: interest costs. As government debt expands, higher interest rates increase the amount governments must spend simply to service existing obligations. Money spent paying interest cannot simultaneously fund infrastructure, healthcare, defense, or education. This creates increasing pressure on future government budgets. Investors closely monitor these trends because higher borrowing costs can influence everything, from economic growth to financial market valuations. None of this means America is losing its position overnight. The U.S. dollar still dominates international trade, global banking, and financial markets. American capital markets remain the deepest and most liquid in the world. Replacing that system would require decades, not months. History shows that reserve currencies rarely disappear suddenly. Instead, they gradually share influence with emerging alternatives as global economic power becomes more diversified. That distinction is incredibly important because dramatic predictions often generate headlines but rarely reflect how financial history actually unfolds. Major transitions are usually slow, uneven, and filled with periods where the existing system appears stronger than ever before. Yet beneath the surface, structural changes continue accumulating until they eventually become impossible to ignore. This is why many long-term investors pay close attention to what central banks do rather than what headlines say. Governments may issue optimistic statements. Markets may celebrate short-term rallies. News cycles constantly shift from one crisis to another. But reserve allocations represent actions instead of opinions. They reveal how institutions responsible for protecting national wealth are positioning themselves for decades ahead rather than reacting to tomorrow's news. If the first 80 years of the post-war financial system were built upon overwhelming confidence in U.S. government debt, the next chapter may be characterized by greater diversification. Gold does not have to replace the dollar for this transition to matter. Even a gradual rebalancing of global reserves can influence bond demand, borrowing costs, and long-term financial conditions across the world. And that leads to the most important question of all. If governments responsible for managing trillions of dollars are quietly preparing for a more uncertain future, what should ordinary investors actually do? Should people completely abandon traditional investments? Should they rush into gold? Or is there a smarter way to think about protecting wealth during one of the biggest financial transitions in generations? In the final part, we'll answer those questions while exploring what this historic shift could realistically mean for the U.S. economy, the dollar, and your financial future over the next decade. Now comes the question that matters most. If central banks are gradually increasing their gold reserves, while the relative share of U.S. government debt in global reserves continues to decline, what does that actually mean for ordinary Americans? Does it mean the dollar is about to collapse? Does it mean the financial system is headed for an immediate crisis? Or does it point to something much slower and perhaps far more important? According to Ray Dalio's long-term debt cycle framework, history rarely moves in straight lines. Great financial powers do not disappear overnight, and reserve currencies do not lose their influence because of a single event. Instead, the process unfolds over many years. Economic leadership gradually shifts. New competitors emerge. Debt accumulates. Productivity changes. Political priorities evolve. The world adapts step by step until one day, people look back and realize the transition had been happening all along. That is why it is important not to confuse a long-term trend with an immediate prediction. The U.S. dollar remains the world's dominant reserve currency. It continues to play a central role in international trade, energy markets, banking, and global finance. There is currently no single alternative capable of replacing it on the same scale. Gold itself cannot replace the dollar because it is not a currency used for everyday commerce. Instead, what we may be witnessing is a gradual evolution toward a more diversified reserve system, one in which central banks rely less on a single asset and spread their reserves across multiple forms of protection. Even gradual changes, however, can have meaningful consequences. If foreign demand for U.S. Treasuries grows more slowly than it did in previous decades, the U.S. government may need to attract buyers by offering higher interest rates. Higher borrowing costs can ripple throughout the economy. Mortgage rates, business loans, credit cards, and corporate financing all tend to be influenced by broader interest rate conditions. Over time, those higher costs can affect investment, housing affordability, and economic growth. At the same time, governments everywhere face difficult fiscal choices. Aging populations, healthcare expenses, infrastructure needs, defense spending, and rising interest payments all compete for limited public resources. These challenges are not unique to the United States. They are visible across many advanced economies. That is why investors increasingly focus on productivity, innovation, and responsible fiscal policy rather than assuming past conditions will automatically continue into the future. This is also where emotion becomes one of the greatest financial risks. Every major transition attracts extreme predictions. Some people insist everything is perfectly fine and nothing will ever change. Others claim total collapse is only months away. History usually follows neither extreme. Instead, change happens gradually through countless small adjustments. Investors who make decisions based on fear often sell quality assets at the worst possible moment. Those who ignore long-term structural trends may also find themselves unprepared. The goal is not to predict every headline. It is to understand the larger forces shaping the world over decades. Ray Dalio has repeatedly emphasized the importance of diversification. Diversification does not guarantee profits or eliminate risk, but it recognizes a simple truth. No one can predict the future with complete certainty. Economies change. Markets surprise us. Policies evolve. A diversified portfolio acknowledges uncertainty instead of pretending certainty exists. That philosophy explains why many professional investors spread assets across stocks, bonds, commodities, cash, and in some cases, precious metals rather than relying entirely on a single investment. Perhaps the biggest lesson from this entire discussion has nothing to do with gold itself. It is about paying attention to incentives. Central banks are responsible for protecting national financial stability. Their actions are usually measured, deliberate, and designed for the long term. When reserve managers quietly adjust their portfolios year after year, they are responding to changes they believe may shape the global economy for decades. Whether every decision proves correct is impossible to know in advance, but ignoring those signals entirely would also be a mistake. History reminds us that every financial era eventually evolves. The British pound once dominated international commerce before the U.S. dollar assumed that role. The dollar itself has remained remarkably resilient for generations because of America's economic strength, deep capital markets, and global influence. Those advantages remain significant today, yet resilience does not mean permanence. Every successful system must continue adapting to new economic realities. As individual investors, the most valuable response is not panic, it is education. Understanding debt cycles, inflation, interest rates, fiscal policy, productivity, and reserve management allows people to make better financial decisions over time. Short-term headlines often create noise, but long-term knowledge creates perspective. The more you understand how the financial system works, the less likely you are to be driven by fear during periods of uncertainty. So perhaps the real story is not that gold has suddenly become more important than U.S. Treasuries. The bigger story is that the institutions managing the world's reserves are quietly preparing for a future they expect to look different from the past. They are acknowledging that uncertainty has increased and that diversification matters more than ever. Whether that transition takes 10 years or 30 years remains to be seen. But history suggests these kinds of structural changes rarely reverse overnight. The question every viewer should ask is not, should I copy what central banks are doing tomorrow morning? A better question, is my financial plan prepared for a world that may look different 10 years from now than it did 10 years ago? That question leads to thoughtful decisions instead of emotional reactions. The financial world has changed many times before, and each generation believed its system would last forever. Yet, history continued moving forward. Today's headlines may eventually become tomorrow's history books, and years from now people may look back at this period as another important chapter in the evolution of the global financial system. If there is one takeaway from everything we've discussed today, it is this: wealth is rarely built by reacting to fear. It is built by understanding long-term trends, staying disciplined through uncertainty, and making informed decisions with patience. Markets will continue to rise and fall. Policies will change. New challenges will emerge. But knowledge remains one of the few assets that compounds for a lifetime. If you found this analysis valuable, subscribe for more deep dives into macroeconomics, global markets, and the long-term financial trends that shape our future. Because the biggest shifts in history rarely announce themselves with a warning. They unfold quietly, one decision at a time, and those who understand them early are often the ones best prepared for whatever comes next.